So our topic today is investing in early stage startups. So can the startups hear me? If you're looking to raise funding, this is the panel you should listen to. Okay, so before we kind of get started on the topic, we don't need your Americanness now, right? I can kind of do that. I'm just gonna go down kind of road. We'll briefly introduce ourselves and how we work with startups. I'll start with myself. My name is Gwen, and I started investing in startups 11 years ago. I spent the last 13 years across the technology, startup, and media space across Asia and a little bit in Silicon Valley. So currently today, I'm an entrepreneur in residence and full-time advisor and problem solver with our deep tech startups. So I'm based in Paris now from Singapore. And one thing I also did in the past was that I spearheaded Mashable into Asia Pacific. So I launched a business in some parts of the world, including Southeast Asia, Australia, and China. So I've seen kind of many different sites where investing in early stage startups, started and founded my own startup as well, sold that company, as well as operated a scale-up where I expanded a startup into international markets. So that's my background. And Ethan.
Hi there, my name is Ethan Pierce. So BorderlessVentures is cross-border investment and advisory between Western Europe, Central Europe, Central Eastern Europe, Southeast Asia, and the US. And then the CryptoAssets Institute is a think tank working with governments, corporates, and funds on the blockchain economy and crypto assets and tokenization, adoption, regulation, all these lovely things.
Hi everybody, my name is David Citron. I'm a partner with Global Founders Capital. We're a €1 billion international VC fund investing across all stages and all sectors. I'm based out of Tel Aviv, managing the Tel Aviv office, primarily focused on early stage, so pre-seed and seed. Sometimes I'll do an A, but my main focus is as early as possible. Been investing in VC for about 8 years, also primarily in Israel and Tel Aviv, and excited to be here.
Hello all, my name is Sriram Prakash. I'm from Deloitte. Deloitte, which many of you know, is the largest professional services company in the world. I'm the global lead for disruptive M&A services at Deloitte. That's a part of the world which helps corporates do investments and deals in startups. Across Deloitte, we work with startups from every shape and form, everything from helping them raise funds to collaborating them to deliver solutions to, of course, helping them with exits and IPO.
Hi, hello, I'm John Soberg. I'm a partner at MS&AD Ventures. We do early stage venture from seed to Series B. My investor is primarily focused on insurance-related businesses, which can be deep tech, AI, cybersecurity, but a lot of insurance. We invest globally, and MS&AD is actually Mitsui Sumitomo, which is the 8th largest insurance company in the world.
Thank you. I just want to get a quick sense of the audience here, because we're kind of small, so I can get, I love audience interaction. Can I get a show of hands? Who here are startups? Okay, that's not a lot. And government or politicians or something? Okay, one, sole hand. And corporates maybe? Okay, quite a few corporates. And who are the rest of you? Are you working? Where are you working? Students? Who are students? No, not students, students. And the rest of you, those who didn't raise your hands, who are you? Define your life. Was that press? All right, press, okay. Media, who's media? A few only. Another investor, okay. Yeah, who are other investors here? Oh, why are you here? I don't understand. Oh, wait, are you late stage investors? Wait, late stage investors? No, early stage investors as well. I don't know why we are talking, because, okay, but thank you so much for giving us that context. Okay, so let's kind of define that. For the startups and students in the audience, this panel is about early stage startups. Is there a difference from an investor's point of view regarding investing in early stage and late stage? We can start with anyone.
Well, I focus mostly on early stage. I've had a few companies that have grown up, I guess you would say, so I've seen quite a bit. I do think early stage is mostly about the team in the market, and later stage is much more about product market fit and scaling. So I actually think it's dramatically different between early stage and late stage. So when I'm doing due diligence, the primary focus early stage is on the team and whether that team has a unique angle for the market that they're going after. And it's actually rare that teams really have something that unique that's really differentiated, but that's, to me, what the kind of makes an early stage company special.
I totally concur. We look into early stages, late stages, but at the same time, the difference sometimes gets blurred very, very quickly. I know unicorns which have become unicorn in 4 years' time. But having said,
Uber and early, what was you just now you mentioned Uber was a startup until like a few days ago.
yeah, I
disagree.
Well, you'll be surprised because, when we say a grown-up companies, we associate things with a fully functional finance function, etc. Go and check out any startup, no matter how many unicorns there are, what do they have below the waist. So to answer your question, I think what's early stage investment for my clients at least is frankly to help them get through the 12 months. It's all about survival. Once you look into late stage, only then the real fund starts to scale up, how quickly can you exit and so forth. So two very, very different things. Totally agree with you.
I think it's fun at the early stage too, though, isn't it?
So I guess I'm not going to say anything interesting because my colleagues said it
We don't have to
already.
go down the line. I hate Q&A in that way.
I mean,
But your fund is interesting because your fund is stage agnostic.
right. So we're stage agnostic. Our methodology is a bit different, where we'll go in as early as possible on the early side of things, and then we'll back the winners again and again and again and again with a large fund. Every now and then we'll see a company that we missed or we didn't have the opportunity to invest in initially, and we'll go in at a later stage, where there we'll have the ability to kind of analyze things on a more scientific level versus on the early stage where it's more of an art. So when I view it, it's kind of like an art versus science, and then as the time goes by, it becomes more scientific and less artistic. And then just on the team side, 100% agree. It's all about the team. Unfortunately, I learned it in the hard way that sometimes you have a rock star team, the market sort of rejects it, like a body rejects a bad organ. And so you really need to make sure that the team, despite being amazing, also understands how the market dynamics work, and they're able to move in a very agile way around the market.
Okay, so how can startups best demonstrate that to you, especially at early stage? Because like you said, it's an art. Mention team, unique angle. I hear words like that, right? At this early stage, how can they best sell their unknown to you?
Right, so counterintuitively, if a company's working in the the medtech space and they're all doctors, that might be great and they might have industry-specific expertise, which is good. But on the flip side, they don't have the entrepreneurial or execution ability. So it's sort of demonstrating a mesh between industry or domain specificity with the team, but also the ability to work to move as like a very graceful beast. And I think that's really important. If it's some sort of combination between you have the good executioners and the science guys, the geeks and the muscle, that's really important for me to see that, and also the ability to identify the market properly and not come with some sort of preconception about how the market works, and then when you try to challenge them, instead of saying okay that makes sense or trying to crystallize the messaging, they'll fight back on you if it doesn't make sense. It's more about really understanding how teams work in a holistic way and not just like in a silo way.
Ethan? Yep.
So I think, for the startups that are here, I think one of the important things to also understand is just because somebody is an investor doesn't mean you should be pitching them your company. Investors have very specific mandates around the amount of money they want to put in, at what stage they want to put in, whether or not it's in your specific activity, whether or not it's in your specific region. So it's kind of a waste of time to just kind of spam every possible investor you can find at an event or online. The most important thing you can do to create that relationship, that opportunity, is to look at startups that are in your space, look at startups that are in your region that have succeeded at raising capital. Go to crunchbase.com, find out who put money into them, and now you start to have a list of targets that you can go looking at of people who invest either in your competitors, although that's not likely to get the investment, but if they're investing in the same vertical, or they invest in your region, but find the things that if you're doing e-commerce for pet supplies and this person's doing e-commerce for luggage, then if you find the person who's investing in e-commerce companies in your region, then you might actually find somebody who would care about what you're doing, or mobile apps or platforms or SaaS or whatever. So find a shopping list of actually qualified leads in terms of investors and go talk to them, because otherwise you spend an awful lot of time talking to people who will never give you any money, not because your thing you're working on isn't interesting, but because you're just talking to somebody who doesn't invest in that specific thing at that specific time.
One question is so related to that. do all of you have an investment thesis? For example, you mentioned luggage or pets or whatever. Some investors go in with like, okay, you know what, we believe that these industries will rise. And then you're like, let's invest in the top 3 or the top team in that industry. Do you look at it that way? Like, do you focus on specific trends that you're looking at?
So
Yeah.
I'm pretty agnostic when it comes to investing. Don't focus on any specific industry. There are certain areas that I like to see more. I'm a huge fan of the voice technology space. I think it's really, really interesting. I like the cyberspace. I'm Israeli, and that's what we do. All we do is cyber. So I focus, I guess, a little bit more. I think as a fund, for us, there are certain areas that we've had a lot of successes in, especially in the e-commerce space, the marketplaces space, the direct-to-consumer spaces. So looking at companies that are in that space is helpful for us because it's sort of a self-fulfilling prophecy or a rigged game for us. We have the expertise, we have the operational know-how, and we've learned from past mistakes, so we're able to help navigate these companies in the right path. So I think if anything, it would make sense to look at what worked well in the past and then double down on those types of investments because you have the insider information, and then try to identify frontier investment opportunities that you have the ability to access good talent in and help the companies grow.
See, I think that's quite interesting, and of course everyone has investment theses, but Deloitte, as acting as middlemen between corporates and startups, we tell them to ignore the hype, right? There's so much of hype there. Say, rather than go chase the hype or chase some startups, why don't you focus on the underlying shifts in technology, the underlying shifts in consumer behavior, and not to forget there's genuine convergence happening between all sorts of industries, which never really happened before. And across these, you will find sweet spots. And as long as you focus on the shifts, that makes for a long-term investment rather than some very short-term just because some company is raising billions of dollars or some particular sector is going through a hype cycle.
I mean, some investors want to flip, no? Not ideal. John, any comments?
Well, I guess I don't know about the flipping. I think some people you have to know when to sell. Selling is probably as big an art as buying, if not more. But that's a whole separate topic. So as far as the investment thesis, I usually tell people that investors are not the people who should be coming up with the thesis because the entrepreneurs are generally leading. So if you have an investor that has a thesis, they're probably wrong, just like most of the ideas are wrong. So I almost never invest in an idea. I invest in markets. So there are markets that are changing. There are opportunities. But if I told you that I knew exactly what was going to happen, then I should start that company because I'd be a billionaire in a couple of years.
So just now, an interesting point was mentioned, right? David, you kind of mentioned that if you missed investing in a company at early stage, your fund at least you can go back in later on. Let's talk about anti-portfolio. Have there been any companies that you've missed out on that you kind of regret later? And so a portfolio that you didn't invest in but are now amazing companies.
I mean, for me, yes, definitely. Most of those companies are the companies who didn't take my money, and not companies that I passed on.
Okay, so they rejected you.
So they rejected me, which is always hard. And those companies that I track till today, and I see their growth, and then I just keep on kicking myself, saying I was right, but it's not helpful. So the only way to learn from that lesson is to kind of figure out what I did wrong and how I couldn't get in the first round, and then sort of tweak my pitch and the way I conduct myself to get to that company next time, and not have them in my anti-portfolio, but actually have them in my portfolio.
I think, yeah, I've got a good anti-portfolio. I think the longer you're in this industry, you have to have an anti-portfolio. If you don't, you haven't seen enough good deals. So I don't know. We've got, I could name a few. In Germany, we could have done Delivery Hero. I think Series A. At the time, we were doing seed, so we passed because it was too late for us. In hindsight, realistically, look, that would have been a fantastic investment. Could have done HelloFresh at the seed round also. There's probably 5 or 10 more. I actually met Indiegogo before they raised any money. At the time, they were only funding side projects in Hollywood, and so I just didn't see it. That one's on me. But there's more.
Yeah, I think it's if you're an investor and the only startups, the only deal flow you're looking at are the ones that are contacting you, then you're probably missing out on a lot of the best stuff in the sense of even no matter how visible you get, unless you're really just tier one, and seeing everything, and even then you might not see it. But the point is, the more that you're actually engaging with ecosystems and meeting founders at various stages of their idea and their execution, you're going to have a running list of things that you missed or that you weren't able to be a part of. But I think the important thing for entrepreneurs to hear in that is that investors are also competing in a sense for amazing founders and amazing projects. It doesn't mean I think you should walk up to them and be arrogant and be like, no, we'll see if we want to take your money. That's probably not a good approach. But for you to understand that there is a dialogue going on here between you pitching them well, but also them pitching the value they can bring to you. And I think it is important to see both of those. And that ends up meaning match doesn't always happen, and there are regrets down the road of good things that didn't work out.
One of my clients missed out on an early investment opportunity in Dollar Shave Club. And people who don't know Dollar Shave Club got sold recently to Unilever for $1 billion. It does subscription-based shaving blades. And the funny thing was the reason they missed out on that, this was years before when their valuation was not even 100 million, was because they said, look at Gillette, it has nearly 70% global share. How are you ever going to compete? How does economies of scale work? But that's the whole point of startup, because what you can do is the amount of fragmentation which is happening is turning so many business models over its head. So partly the learning is having some leap of faith, but also the shifts. Because some of the shifts which we are seeing, like subscription model, some of the economies of scale, how that's turning, these are going to remain. They're not changing. So make sure you spot those shifts, you ride those shifts.
I just want to quickly pause and go to the audience, yeah? So in a few minutes, 5 minutes or so, if you have any questions, feel free to raise your hands, okay? But I'm going to go to another question now regarding deal structuring. When you look at a potential investment, how do you structure your deals? Do you solve for simplicity of terms, or you trying to get the best price for your investment? Like, for example, is a additional 2x, 1x, 2x liquidation preference, is it worth an additional valuation? 5x valuation, for example?
I tend to try to figure out what I think is going to be best for the company. So, I think every once in a while, if you see the aggressive liquidation preference, it's probably because the CEO wanted a really high valuation. My typical term sheet doesn't have that, but if they're really aggressive about asking for a valuation that's above where they're at, then maybe you'd put it in. I'm more inclined to try to figure out who should be in the deal. So who can best help this company at this stage is more important to me than the actual terms.
I agree with John. It's more of a collaborative versus adversarial kind of dance with founders. Sometimes they take the more aggressive route. Sometimes I'll be a little bit not so friendly, just to make sure that the deal is right for all of us, and we set the benchmark in a proper way. Especially in early stage, the last thing I want is to have an inflated valuation. We'll have to start chasing our tails next round, start dealing with down rounds. It doesn't make sense. A lot of founders don't see it that way, and they're like, I got to maximize my valuation from day one, and they don't really realize that it's a long game and a short game simultaneously, which is kind of frustrating for them to internalize. For the most part, sometimes they get it from day one. So yeah, it's more about just figuring out what's right for both sides, where everybody's happy. I don't want to have the day two from post-investment be a day where the founder doesn't like me because he feels like I screwed him, or vice versa. And then for us, we're also a little bit valuation insensitive. We don't really care if it's a little bit to here, a little bit to there. If we feel like we need to increase our position as time goes by, we can do that as a larger fund. But even as smaller investors, they should view it as as a partnership and a marriage, and not so much as like a transaction of you give me this and I give you that.
I think it's also, not everything is destined to be a unicorn. So, in fact, I don't think anybody who's founding a company, if they're being realistic, thinks they're founding a unicorn. Hopefully you're aiming to found a $100 million business, and then you get lucky with some product market fit and the right timing, and that thing actually matters on a larger level. But I don't know the exact numbers, but when something like Uber raises loses around 5 million or so, and there's at the beginning for around 20% equity dilution, and then they're still worth 50 billion plus when they IPO. That means there's room to grow for those bigger things, but you still have to put a lot on the table at the beginning. that doesn't necessarily change. I think for founders, I think the important thing is to really understand that it's a long game, but you do have to protect yourself at each round. The right investors, the good ones, are maximizing your potential and their potential at the same time. If an investor is abusing you in the contract negotiations for this thing, then they're not realizing that if they strangle you, you can't create value, which means they're not creating value for themselves. So that's important, but that doesn't mean the investor is going to let you do anything you want to and not create a good deal. But I think more importantly, what matters in a lot of that for people is just to realize that this is not about one or two people building a company and creating just massive amounts of money for you. This is a team approach, and the reality is if you're building something that's going to be worth more than 10, 20, 30 million dollars, it makes a lot more sense to own 5 or 10% of something that's worth a lot than 80 to 100% of something that's worth practically nothing. So you do have to put a lot on the table, quote unquote, a lot, but in order to be able to create something that scales, but the value comes back to you if you're building something in that space. But I do think it's very important that people be realistic about the business they're building. Are you building what kind of revenue and valuation are you realistically going to be able to build? Is it 50 million? Is it 100 million? Is it half a billion? Is it billions? Because that will influence your decisions along the way and where you see your opportunity in terms of the value creation of that. So I think your investors should realize that as well.
I agree with the panel. I think value is more an art than a science, of course. Valuation, but valuation today is really in the eye of the suitor. Let's take a payments company. Let's take a fintech company, right? I can sell a fintech company to a bank, insurance, a retailer, a mobile player, FMCG. Each one will value it totally differently. So you can't really start saying that, well, I'm setting up a company, it's worth $1 billion, because it depends on whom you're talking to. And every investor, I think my advice to startups is don't get hung on by your elevator pitch, because so many startups come to me and say, oh, I'm the Uber of travel, and suddenly in their head, they're associating themselves with Uber's valuation, and that's what we're doing. And the investors, they're looking at, well, I've sold a company to a tech before, so that's the sort of valuation. But what you need to realize as investors is there's a whole suite of non-tech buyers who are interested in tech assets. And that's totally changing the valuation as well as what's happening to the market out of kilter.
Are there any questions from the audience? Yes, please. Is there a mic that you have? No? If not, do you mind, John, do you mind passing the mic? Yeah.
Okay. My name is Emilian, running a blockchain startup really focused on the practical implications with some pilots and customers. So recently we are being advised to consider security token offering by a number of organizations, but we are still at the early stage. We have some revenue history, we have some ongoing projects, but is it a good idea to go for an STO for a blockchain startup at this stage of development?
So let's start with Ethan, and then I would love to also hear from, I guess, traditional VC, how you see the new world.
So a security token offering, what we're seeing is that most of these are not equities, they're revenue shares, the ones that are being interesting. If you're looking to raise equity-based capital, there's probably better ways to do that and simpler and cheaper ways to do that right now. But what we're seeing with most security token offerings, a security token offering just means tokenized security, meaning that you are taking the investment and you're tokenizing that versus it's not about. The word security is misleading. It just means that you are creating an investment that is regulated by your central banking authority in your country, however that regulation works. So the issue there is if we're talking about a revenue sharing security token offering, there's also profit shares, but those people don't want to do either because the accountants hide all the money and you don't make any profit, any revenue in the end, so it doesn't matter. But so it's all revenue share. Why does that matter? It matters because if you're an idea on paper, if you are working on product market fit, if you're working on your MVP, then there's no reason that somebody should give you money in return for revenue share. So at that stage, you are looking for some kind of bootstrapping capital, whether it is whatever that happens to be, in terms of all the different options that are there for you. I think if you're going to run a security token offering, you need to do it within 1 or 2 quarters of creating revenue that you can start to distribute to the people who have backed that offering. Otherwise, you're going to run into issues with your community of investors not being happy with where you're at. I don't think it has to be a lot of revenue, but what you need to see is that you just show enough traction that I'm going to give you, you're going to see a couple cents or a couple dollars this quarter in dividends, and next quarter it will be more than that. And the quarter after that, it will be more than that. But if it is pretty much zero and traction isn't happening yet in your company, I don't believe that a security token offering makes sense.
involved in investing in? Nope.
I see a lot of blockchain technologies in Israel, and where there was a whole hype around ICOs, a lot of not so nice companies taking advantage of the wave of ICOs. For me personally, I'm not so focused on blockchain. When I do look at companies that are using the blockchain for their product, I'll focus more on the product and their execution and less on the tokenized element of the blockchain. It's not interesting for me. I don't know enough about it to make an educated decision. So it's more of how they use the technology for a product and not how they use the technology to issue tokens.
So just to connect on that, you are a blockchain startup and you're talking about a security token offering. The reality is security token offerings have nothing to do with blockchain and have nothing to do with startups in the most sense. They're really about SMEs, for small and medium businesses, for real estate, for intellectual property, for all kinds of things. They make sense for startups, but if you're something that has some kind of an MRR, a monthly recurring revenue, some kind of traction, Facebook would have been a lousy STO, whereas Uber would have been a great one. Because you automatically can see that as users grow, revenue grows. Not necessarily profit, especially in a scale-up, but in that sense. So I wouldn't also not, for people who don't know a lot about that, these are not actually about blockchain startups, and they're really not just localized on startups. So 25 billion went into ICOs. Last year, 35 billion in early stage VC. There's a $4 trillion funding gap for SMEs in Europe alone. And the real estate and intellectual property markets are multiples of that in terms of opportunity. So it's actually not a startup game in the STO space.
Any other questions? Yes.
Yeah,
please.
hi. I'm Animesh from NLP Bots. We are an AI NLP horizontal platform that automates conversations and processes. So my question to you is, which is your prime motivator when you look to invest? Is it the product? Is it the technology? Is it the team? Or is there something else? What is the? I understand it's a factor of all of these, obviously, but for you, which is the prime motivator or the prime, the tipping point?
I think it depends on the stage, but since we're talking about early stage right now, it's not the product for me. It's the team and the market opportunity. And then I would say, one thing that it's hard for founders to understand, but part of our job is to compare apples and oranges and decide which ones we like that day. So I'm comparing your startup to every other industry and every other founder in the room. And so you could be the best at what you do, and that may or may not make you the best investment for me. So that's a hard one for anybody to really quantify. But at the end of the day, for me, it's mostly about the team and how big I think that opportunity is.
I'm going to add in, even though I'm the moderator here, because the fund I'm with now, Entrepreneur Fest, we are a talent investor. So we create deal flow for everyone here. So we invest in individuals, pre-idea, pre-team. So the team is the most important. We're literally interviewing people, a lot of deep tech people, PhDs and postdocs, and we're looking whether we feel like they have the entrepreneurial mindset. That's super, we're taking the thesis of investing in people and team to the very extreme. So team, especially for early stage.
2 quick points. I think teams are very important. I think what a lot of people don't realize when they're pitching a project, especially something that's very current and not necessarily trendy, but very makes sense right now, is that there's a good chance that the people you're pitching to have already seen or heard or will hear the exact same or similar startup or business model 10 times within a 2 to 3 month period. Are they really evaluating your business model and your company, or are they evaluating whether or not you're the one who will execute on a business model that they already understand or are looking into? I think that's an important thing to kind of look at. There was a lot of studies done as well. I forget the guy's name that did a big study on it, but people raise lots of money and they fail. Amazing teams fail. Great ideas fail. Great execution can still fail. What is the one thing that seems to always matter with startups, especially in the early to mid stage? It's timing. Because you can have all those things or not those things, but if you are starting the company 6 months, a year and a half, 2 years, 3 years before that thing makes sense or after it makes sense, it's problematic. People spend almost $1 billion trying to sell shoes in the end of the 90s and the 2000s, and it took Zappos until the mid-2000s to finally be able to crack that thing. So it was a timing issue. It wasn't capital, it wasn't team, it wasn't anything else. But I do think team is incredibly important in terms of execution, but it turns out if you're building everything right, but you're building it too soon, then you won't get market adoption in the way you want. And if you're building it just a little bit or a lot too late, somebody else is probably already doing it better.
We have one more question, yeah, please.
Hi, my name is Kauyan. I have an edtech startup with AI. And since the team is the most important thing for earlier investing, for example, I come to you guys and say, what's your plan? I have this plan, I need 100 euros. You like me, you say, okay, I'll give you 100 euros for 10% of the company. But then on the other side, because we want to feel comfortable, because I'm in Bulgaria, you're in Singapore, you're in the US, etc. I say, okay, but you have to move with your team, here in the US or in the Singapore. I said, fine, but then I need, not 100 euros, I need 150 euros because the living expenses in Singapore and the US are a lot higher than here in Bulgaria. For me, for the product, for the customer, it doesn't matter if I do it from here or from Singapore, but for you to, to feel comfort, the earlier, investors from the East Coast invest in the East Coast companies, usually. The West Coast from the West Coast. So if you make me come to Singapore, and then I will ask, okay, give me 150 euros, but are you gonna penalize me by taking 15% of the company instead of 10% because you make me move to Singapore or to the US? So that's pretty much the question.
Any comments? Geographical limitations, investment? Yeah.
So we're an international fund. We're investing around the world, pretty much everywhere. So we're not so limited as far as the geography. We also have boots on the ground almost in every location. So we're able to bridge that geographical gap. Me personally, as somebody who's been in Israel and investing in Israel for quite some time, most Israeli companies from the get-go are not focused on the Israeli market or the region, which is unfortunately not so friendly to Israel. So it's either going to the States first or Western Europe, maybe sometimes the APAC region. It's never in the specific location. So a lot of the times, one of the founders will eventually relocate, but it's not a prerequisite. We know that it's all about ability to execute and work harder. If you have to work at 3 in the morning because you have to bridge that time zone gap, you'll do it. So we're not so focused on pick up your stuff and move to the target market immediately. It doesn't really make sense, especially in an early stage. You haven't really proved anything. So just the sheer amount of waste that would occur from taking an extra 100% of the funding just to relocate and build a team in the local market. As an investor, that wouldn't make sense. I wouldn't want to take that risk so early on in the game. I would want to see what you can do from afar, maybe by traveling every now and then. But just that necessity to relocate immediately doesn't make sense to me, and that wouldn't be a deal breaker for me ever, I think.
I find it a bit strange when investors ask teams to get relocated, unless there's a very valid reason. Say, for example, sometimes teams ask to get relocated to London because you're raising finance, or a particular center because you can access skills there, or a particular set of clients. But other than that, just to relocate because an investor's base there sounds strange. But from a corporate perspective, I work with a lot of corporate venture capital, and one of the things we tell them is, most of the multinationals, you've got teams, armies of teams in virtually every country. So how do you ensure that you connect with the local ecosystem? So if someone might be in Bulgaria, the decision might well be made in Silicon Valley or somewhere else, but how do you use your local team to incubate and make sure that this team is scaling up? So that's one advantage which I've seen which corporate ventures bring in.
Well, one thing that I just want to add, it's also a matter of where you relocate to. So a lot of Israeli companies will ask them, okay, when you phase 2, when you start the relocation program, where are you going? They all say, most of them say Silicon Valley, Silicon Valley, Silicon Valley. Sometimes that makes sense. Most of the time it doesn't. If you're focusing on the insurance space, maybe Silicon Valley isn't the best place to be. Maybe you should be in New York or in Connecticut or somewhere on the East Coast. If you're really far away from the West Coast, maybe you should be in the East Coast to split the time difference so you don't have to work at 3 in the morning when you're working with your colleagues that are locally on the ground. Certain industries have advantages of being in certain locations, so I guess maybe CPG would have different advantages in a different location in the States. Maybe retail is a huge booming industry in Texas now. So you have to put a little bit of thought on where you're relocating to, and not just should I relocate or not.
I'll throw out one little thought. I think Ethan actually covered this best in one of his earlier comments. You need to figure out who's the right investor for you. Because if you go to 5 of these panels and you listen to 25 answers on this question, they might all be different. So there are definitely preferences with different investors. Some people want you to be really close. Some people don't care. Some people want you to be right next to your customers. Some people want you next to talent. Some people want you next to investments. There's not a right or wrong answer necessarily, but there is an answer for you, for your company. And so I think the most important thing is that you find an investor that fits with the path that you expect to take.
I think that's the exact thing there is that match between you. Because finding the right investor for a company is not just about finding who is willing to give you money. It's what do they bring on top of that money. Not every investor has to be a smart investor for you, but maybe one of the reasons they're asking you to move in their space in terms of their region is because that's where their network is. That's where their leverage is to help build your company. And maybe that's not the right thing at that point in time. But I think the issue is if somebody's wanting to give you money to help you grow, most likely they have something else they're wanting to bring to you as well. Their experience in that vertical, their network, the leverage that they have, whatever those things are that they can potentially bring to you to help you scale your company. And a lot of that works better when you're close to people in the same city or region. It's harder to extend that if you're not. So I think that maybe that's where that's at. But I think pulling back from that, we're not seeing as much flipping as we used to, simply because there's a lot of capital everywhere and a lot of people doing lots of amazing things. I do think, however, you can build all the wonderful tech you want to in Bulgaria, but if you're doing a SaaS, a B2B model or something where you need to sell to other scale-ups or other things, you have to open a sales office in the Valley, you have to open an office in Asia, because that's where your clients are going to be. But that's not necessarily flipping the company as it's in terms of its headquarters and where it's based at. That's just growing up and going to the places where business is done.
So last question. We kind of talked about it earlier, finding you need to pick the right investor. So I'll close with this. For all the investors here, and then Sriram as well related, why should startups pick you to work with, to be their investor? And Sriram, for you, why should they work with Deloitte? Let's start from this way now.
Oh, that's a tough question.
Yeah, why should they pick you?
So, I guess what I would tell you is that I've done about 80 investments now across over the past 10 years. So I've seen a lot. So if it's a fit between areas that I know pretty well or that I have a good network in, then I can probably add quite a bit of value for you. The fact that I also have a multinational insurance company behind me that has a footprint in 47 countries, if there's interest there that we can help with, we have some potential for business development. And I've done a lot of early stage. So from an early stage perspective, I've also seen an awful lot.
Thank you.
My pitch, the role reversal. Okay, I think. It's interesting you ask that, because actually the funny thing is, even though Deloitte is such a huge company, we are over 100 countries and whatnot, a lot of startups are very, very hesitant to talk to large corporates, not just Deloitte, but any large corporate. And Deloitte per se, the advantage it really brings is that today everything is around innovation, and given our breadth of connectivity in local markets, over 100 countries, etc., no matter which country I go, I know there is a Deloitte office. But more importantly, our connectivity with the large corporates. How many companies can you think of which have connection with the 1,000 largest companies in the world? We are on first name basis with the board. So having this unique access to the largest corporates who are going to be your clients and local access makes Deloitte a genuine differentiator. So that's me flying the flag for the corporates.
Thank you. Yeah, and that's important. Startups don't realize that they want to sell to corporates. They need to.
And one last thing. Ultimately, right? It's great to sell, but at some point you're going to scale up. You need new investments. You need to exit. Exit is always needs to be front and center at some point, and that's where the large ones come in. And for that, we make a very, very conscious efforts. We can't just parade around just because we are Deloitte. Come to us when you reach 100 million valuations. Just simply doesn't work. That's why we spend an awful amount of time understanding, working with some of the early startups, sometimes even in pro bono situations, so that when they eventually become big, they become our clients.
Thank you.
So for us, the pitch is pretty straightforward. We're a big fund. We're operating out of every corner of the globe pretty much. But the mindset is also sort of like a mesh between a micro VC and a PE firm. So the agility of a micro VC and the firepower of a PE firm, where we'll invest early on and then invest again and again and again if we see the company's doing good things. We'll be there a long-lasting partner. That's one aspect. The other aspect is just operational expertise that we've accumulated over time. We've got a pretty big portfolio, a lot of successes in our portfolio companies like Delivery Hero and HelloFresh that have grown to multi-billion-dollar companies. So we know how to navigate the rough waters when need be, and to be a passive partner at other times. So that's super important. I think it's a very compelling pitch to startups. And then lastly, it's a pitch that I give locally is, I mean, I'm a young guy. I still got, a knife between my teeth. I'll fight, tooth and nail for anything that the company needs. And I really try to bring the extra, personal value other than just say like we're a big fund, blah, 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 and really show them that there's a partner there and not somebody who's just giving them money and waiting to collect the check in 5 years.
Thank you.
Yeah, so in terms of personal investments, I only invest in companies I'm advising, and Borderless is really about helping companies scale out of their region, whether it's from Central Eastern Europe to Western Europe to the US or to Southeast Asia. So it's really, for me, my value add is not so much a vertical specific thing. Only about 10% of what I would do is really in blockchain or crypto. It's in lots of other things. It's about helping them through network and corporate business development and other things really scale outside of where they've kind of started at, like you mentioned, if you're here and you're trying to go to other places. So I think that's really kind of, for me, the important piece. Not vertically specific, and I think that's an important thing. A lot of people only look for people in their space, and the reality is there's a lot of people who can help you build your company, whether it's through fundraising, direct investment, or advisory, who are not necessarily experienced in your specific vertical, but they're very experienced in taking companies like yours into other markets or into other situations. So that's what I do.
Thank you. And quickly on my side, my angel investments, I focus on Asia, so if your market is Asia, please talk to me. So thank you so much, John, Sriram, David, and Ethan. My name is Gwen, so
Thanks,
enjoy
Gwen.
the rest of your day.
Gwen.